Welcome back. This is episode 232. This week I'm joined again by fellow fee-only financial advisor and University of Delaware Blue Hen graduate, Andy Panko. And Andy is the president of Tenon Financial, located in New Jersey. And today we're going to discuss annuities and the use of annuities for income and retirement. And we'll also talk about a recent case study that Andy had where you could learn some more about how an annuity could make sense potentially in retirement. Welcome, Andy.
Hey, thanks for having me. Looking forward to this. Always a fun topic.
Yeah, and listeners will know that I'm definitely, I'll land on the Ken Fisher side of, I don't necessarily hate annuities, but I'm not a big fan of them generally for, sure a lot of reasons, that are out there. But what we're going to talk about how, some of the good reasons why, it could make sense.
Makes sense. I'm in.
All right. So, we were talking earlier before we started about a recent client you worked with where, an annuity made sense. But let me just take a step back in the sense that when you do retire, and maybe see if you agree with this, I would say to dumb it down, you have really two options as far as how you can generate income. You can invest however you like, and you can take systematic withdrawals from your portfolio, whatever that might be, stocks, bonds, whatever. Or you could use an annuity, to take income with a guarantee in the sense that the annuity company is guaranteeing you those payments usually for life.
Correct. Yeah, I'd agree with that. There's also Social Security pension if you have it, but those are things like you're going to kind of have off on the side. They're not really something you can do with the investable assets you have, which to your point, that boils down really into two things. Invest it and take distributions as necessary, or buy an annuity with it to get guaranteed income from an insurance company.
That's right. Yeah. For your nest egg, I should have prefaced. Yeah.
Right. Now, there will be some people that try to say you can use cash value life insurance as an income tool, but I would stay far away from that for the most part, because that's playing with fire, because that's predicated on taking loans for the rest of your life. So let's assume that's not an option for purposes of our discussion.
Yeah, we kind of debunked that when you came on before, when we talked about the 7 myths of index universal life insurance last time. So If you want to learn more about that, Andy's put out a lot of great content about that. You can go back to that episode or head over to his webpage. Yeah, so getting into this, right? So you've got a nest egg, right? Let's say you've got $500,000 and you're trying to decide, all right, or maybe you've already decided that you're leaning on the side of guaranteed income. Like the financial markets scare you. You don't want to see your money fluctuating. You're a conservative investor, and you figure, okay, I need X amount of dollars per month. Like, how could you do that with an annuity type product?
Yeah, so and I don't want to make this a discussion of should or shouldn't you get an annuity. Let's assume the person or the advisor helps the person decide yes. They want a certain amount of guaranteed income, of which there's only three sources: Social Security, pension, or annuity. The only true three guaranteed monthly incomes. So let's assume pension and or Social Security are what they are. In addition to that, this person wants, for whatever the reasons may be, maybe they're super conservative, let's just say, but they want, in the example I was working with a client, they want $600 per month guaranteed for the rest of their life, but with some sort of money left over if they are to die early, because they have a partner they want to leave something to. Not a joint life payment, because the partner isn't a spouse, so you're not allowed technically to have like a joint life where, meaning if I die, my payments continue on for my spouse. That wasn't an option here. They just wanted something if they die early, that there's some sort of something left for this person. Or if they live a normal or longer life expectancy, then they're not expecting there to be anything left. So what this person was ultimately looking for was a very simple, plain vanilla, in effect, buying herself a little bit of pension, if you will, I want to call it that, $600 a month for life with something left over if she dies early. So we were looking around for something called a single premium immediate annuity with cash refund, where cash refund simply means if you die before receiving back enough payments to recoup your initial premium, the insurance company, quote unquote, refunds the remainder to whoever you designate as the beneficiary. So if you die, 1 month in, there's going to be a lot of cash refund left because you basically get all your premium back, minus that 1 month payment. Or if you live 50 years, you will have, gotten back more payments than what you paid in, so there's no cash refund. But that's what we're looking for.
So an
the
example,
task
like
was,
you put in 100,000, right? If you've only gotten back 50,000 from monthly payments and you die, your estate gets the remaining 50,000.
yeah, well, not your state. I mean, you would designate a specific
Estate, I
beneficiary
said,
on
sorry.
it, but yeah, your beneficiary gets
Yeah.
exactly. Yeah, I know where you're going, but your beneficiary gets the remaining $50,000 paid out to them. Yeah,
Okay, I just wanted to clarify that.
right. Yeah, no, understood. And just wanted to say you preface this at the beginning. I'm fee only. For those who don't know, fee only means don't sell products for commission. That includes insurance. So I don't sell annuities. I make no money off of someone buying an annuity, but I see their value when they make sense. I think for what it's worth, like we talked about in our IUL chat before, insurance products, including annuities, are often way oversold. They're sold more than they're bought. A lot of them are very complicated, more expensive than they need to be, confusing, and not the best solution for people. But there are times, and often it's one of these more plain vanilla scenarios where someone really just wants a guaranteed pension-like monthly income, where an annuity is or could be the best solution for that person. So I'm open to that and considering it as was the case here.
Yeah, definitely. I would agree 100% with everything you said. That I don't sell annuities either, and
Right.
definitely see them missold a lot. But for that client, as I prefaced, who just wants that mailbox money, right, that conservative money, this could be a home run for them because it's a low risk investment.
Right. So in the case of the client I was working with, we knew what we were solving for. Pretty simple. $600 a month, and she was early 60s, has no reason to think she's going to live exceptionally long or short. She's let's assume normal average life expectancy. So she knew, based on the analysis we did and cash flow modeling, and based on the other assets that she had still invested and was comfortable in having in the markets in traditional securities. It ultimately came down, she wants $600 a month for life as long as she lives, and with something left over if she were to die early. So pretty simple what we're solving for. So now it was, okay, what's the best form of annuity to most efficiently and most cost effectively satisfy that for her? So I started helping her shop around, and again, I'm fee only. I can't sell annuities. So what I did was I looked on the publicly available sources like immediateannuities.com. And I'm not saying people should or shouldn't use that, but I think it's a nice source. It is an insurance agent's website, but there's free quotes you can get on there. You do not need to cough up your name or email or contact information. So there's no risk of like, oh, let me get a quote. Now you're on some mailing list. Like they don't do that, which is cool. So it's a great spot to get some indications of what you can reasonably expect if you want a certain amount or you put a certain amount in. So we started there, got some figures in mind for how much premium it's going to cost to buy this $600 a month with cash refund. And the amounts we were looking at, there's a few different ones on there, but it was like $107,000 to $112,000 of one-time lump sum premium to buy this single premium immediate annuity with cash refund. So that was one data point. Next, I looked on Retire One, which I think is another sort of fee-only focused kind of brokerage. Blueprint Income, I think she looked on. I think that's more of a client focus. I might be getting the two confused. But the point is there's other sort of publicly available spots that agents will kind of give you quotes through. So she and I looked there, and they all sort of jived. It was, $105-ish to $112-ish thousand, or 107 to 112. And I figured, let me also reach out to agents, because who knows, maybe the stuff on these sites isn't the best product available. Maybe you need someone who separately has contacts with certain insurers that choose to not put their products on these public-facing sites. So I'm a member of the Financial Planning Association, and I'm a relatively active contributor to they have like a message board there, basically a chat board. And I just reached out there. I said, hey, here's what I'm looking for. And I know there's a lot of insurance folks in the FPA, so I thought that'd be a decent spot to try to get someone to help me out. And I said, hey, here's what I'm doing. I already looked on the public websites. I'm looking for an agent to help me possibly also, source some quotes from other carriers not on these sites. And I got in touch with one or two people that way. They pulled some quotes. And what's cool was I was doing all the work on behalf of the client. I didn't want to just tell the client, because I don't sell annuities, I didn't want to be like, hey, go contact an annuity person, right? Because who knows what they're going to come back with.
They'd say, put all your money in this variable annuity, right? With a 3.5%.
Yeah, exactly. So
ongoing fee.
I wanted to help shield her from that. And I'm fee only, flat fee. So like I view my fee as a comprehensive advice giving fee, not just to do only certain things for her. So I was like, yeah, I'll help. I'll do some of the legwork. I understand annuities better than she's sharp, but I know more about them than she does. So I was like, I'll do the screening for you. I'll cut through the sales pitch and I'll try to find the ones that truly seem to make sense. And so I talked with this agent on her behalf. His options, same thing. We're all in the same ballpark as the quotes we already found online. And then I reached out to another agent who was recommended to me by someone else in the industry who I trust, and got in touch with that person. And he did the same thing. He looked at SPIAs for us and came back with the same roster of quotes. But he also looked further. He was like, well, why limit ourselves to SPIAs? Let's consider other forms of annuities like fixed index annuities or variable annuities, knowing that what you ultimately want is $600 a month guaranteed with something left over if you die soon. We could in effect replicate that or something close to that by buying a deferred annuity where you're not actually, giving up control and ownership of your lump sum, but with some guaranteed withdrawal rider tacked onto it to ensure you get that $600 a month for life. So he shopped around and he ultimately came back with a fixed indexed annuity with a guaranteed withdrawal rider where you can start the rider ASAP, effectively, immediately. And to produce $600 a month of guaranteed income under this withdrawal rider, it would only cost $102,000 of initial premium versus the lowest cost, SPIA that we found was $107,000, I think it was. Okay. And it was a well-rated insurer. I don't want to name names, but it's not an insurer who's like a B rated or something you need to be concerned about. It was legit, well-known, highly rated insurer. And so that's ultimately what she ended up buying. And the $600 a month cost her $5,000 less in premium, which is pretty big on $100,000, right? Now it's not quite identical. Like the cash refund feature and math isn't identical to what's left over of contract value in this fixed index annuity, because the contract value is a little more variable. Not to be too technical, but the amount of the value of the annuity can change as the interest is credited to it based on the indexing mechanics and what the underlying index does or whatever. Whereas cash refund simply, every dollar you get in premium payment reduces the dollar amount of cash refund left. It's very linear, very clean. So ultimately, if she is to die early, it's possible the amount that her heir walks away with is less under this option than it would have been under the SPIA with cash refund, or it could be more. We don't know, but it's more variable. But that was something she was okay with. So there'd still be some non-zero value left for an heir if she dies prematurely.
So is this product, is it because it's an indexed annuity, so it's eligible to earn interest like every year based off an index that you pick, or?
Exactly. So there's really kind of two things at play here that will impact the contract value. Well, I guess I should say three. One is there's a fee for this rider, and I think it's like 1.2% per year. So all else equal, the account balance of that $102,000 she put in is going to go down by 1.2% in rider fee. The amount she takes out, so $600 a month is $7,200 a year. All else equal, again, the contract value is going down by $7,200 a year. The interest crediting could be anything between zero and something higher than zero any given year. And this is the variable part. Yeah. We don't know what it's going to be. It's based off of the particular index she chose in this is the S&P 500. So the amount of interest she gets will be anywhere from 0 to I forget what the cap is, but upwards of maybe 10% at most.
Sure, there's a cap, so there's a
Depending on the
maximum. That's how these index annuities
Correct.
work, right? The cap
Yeah.
is usually set when you buy the product, and if it's 10% in your example, the S&P goes up 20, you earn 10. But if it went
Correct.
up
That's
5, you'd earn 5, and if it
Yep.
went down 20, you would get nothing that year.
You get
Yeah.
0. That's
Yeah.
correct. So, and so I think a reasonable expectation for average annualized interest crediting over the long term in one of these products is mid-single digit percent.
Yeah, 4 or 5%.
5-ish, give or take, right? Again, some years will be 0, some years will be higher, but assume 5-ish, give or take. No one should expect they're getting 15, 20% in a fixed index annuity. You may have some freaky years where you do, but long term it's not.
Or even the
gonna
cap, right? I think that's where people go wrong is they think, oh, I'm going to get the cap every year. And then,
Right.
like you said, you're not going to. And when you throw a couple zeros in there, it drastically underperforms the index if that's what your goal is, right? To track the index.
Yeah. These will never, by design, they will never perform as well as the pure index itself. But again, if you have that expectation, understanding in mind, like I told her, don't expect more than mid-single digit percent. And you're losing that 1.2% every year in rider fee. So let's just assume on average, you're going to annualize 4-ish%. I'm making this up again. I don't really know because we don't know the future. But she was okay with that. Now, she's okay with it because of what she wanted and needed from this product. She's not buying it for accumulation and growth. If she was looking to maximize long-term growth, absolutely not. This would in no way be the right product for her. But first and foremost, she wanted guaranteed income with something left over. She doesn't particularly care about maximizing that something left over. She just wanted something left over if she dies early.
Yeah, she didn't want to know
So
that
this-
like she gave up this $107,000 in your original example, right? Maybe it had no cash refund, and like she dies 1 year later, $100,000 is gone from her, estate going to her beneficiaries. Right,
Right, there's
gone.
nothing. Yeah.
So this way, there's
Yeah.
some potential value that's going to come back to her estate. It all just depends on how long she lives, right, and how the index does. Yeah.
Yep. Yeah. If she lives 20 years, she's fine, expecting there to be nothing left over. Her concern was really, again, she's early 60s. If she dies at 70, like she'd like there to be something, which this checked that box. So I think this was a great use case. A lot of people, rightfully so, are very turned off by annuities because they get a bad rap because they are often missold. But if you're able to cut through the noise and truly pragmatically analyze the product, what it does, what it doesn't do, and you're clear what to expect from it, it could be a great solution. Again, coming back to where your primary objective is guaranteed income, annuities should be in consideration. For people who don't want or need guaranteed income, then annuities start to lose a lot of their luster. Now there's different use cases, like you can use them as CD replacements, for short-term kind of cash equivalent guaranteed interest. But for when it comes down to ultimately I want and need guaranteed income, annuities have to be in the mix.
Definitely. What about inflation adjustment? Is there any? That's $7,600 a year, or $600 a month.
Yeah,
7,200. Yeah. Does that go up at all in the future for like inflation?
No. Vast majority of annuities don't. So it's like a traditional pension in that sense, a pension without cost of living adjustment, obviously. But no, the $600 a month she gets now is going to be the same $600 a month she gets if she lives 40 years to 102, 103. And she was aware of that. Now, some annuities, you do have the option to buy some sort of inflation rider or, have your payments go up over time. But as you would expect, that's not free. You're now putting that inflation risk on the insurance company, so you're going to pay for it. And so if you wanted the same $600 a month to start, you're going to have to pay substantially more in premium if you're going to have an inflation adjustment, that's $600. Or if you want to pay the same, $102,000, you're going to get substantially less payment to start off.
Sure.
And I believe no annuity now has full, uncapped, unlimited inflation adjustment like 2022 when there's 8 or 9% CPI inflation. I don't think any new annuity today has full CPI protection. If it does, it's going to be so ungodly expensive to buy because of that risk. I understand there are some, or from what I'm told, there's some annuities that have like a cap at 2 or cap at 3% annual inflation increase. Again, you pay for it, but it is an option for those who want or need that. But she was okay with this fixed, static, non-inflation adjusted payment because she still has, like I said before, she still has a pretty decent pot of traditional investable assets where stocks, historically speaking, have been one of the better inflation hedges. So she still has money invested in the market. She still has money exposed for, hoping for long-term growth and inflation-adjusted good returns. That's how she's addressing inflation. She's not trying to address it with this annuity because that would be just, cost prohibitive to do.
Yeah, it would be hard because over time, at a 3% rate of inflation in 20 years, right, the cost of things are going to double. You'd be buying half of what you're buying on day one. If that was your only income source, right? Like you just had a fixed amount. You need your, an income to go up over time with inflation, the majority of it.
And this is why Social Security, I think, kind of core of what I do is maximizing Social Security because that's the best annuity people can buy. You don't technically buy it, but you know what I mean. If you want to delay your payment, you're in effect buying it because you're foregoing payments while you delay. But inflation adjusted, who knows, maybe that'll change. But as of now, there's full CPI inflation adjustment to Social Security that might get capped and reduced at some point. But so that was kind of the backbone, the foundation of her income plan is Social Security. So that has some inflation protection to it. And then again, she has, equities for the longer term hoped for inflation hedge.
Yeah. Yeah. And also if you do the math, the 7,200, you think you said she had to put in 102,000. It's a 7% payout that she's getting, on her money to start. If I did that right, I think I did. That's pretty good. I mean, you're starting at a pretty high payout, so it is putting you probably ahead of where you would have been with other options, right? Other investment products you could have been using,
Yeah, it's hard. I struggle with this. It's hard to. They're kind of apples and oranges, like annuities, guaranteed income annuities versus traditional investable assets. Like you said, and this was proper terminology, 7.2% payout, right? It's not a return. The return's not 7.2 because part of the payment she's getting every month is a return of her principal. So you can't consider that like financial return like you do in the investment sense. So I ran like an internal rate of return calculation on this. What if she lived to average age of, let's say, 85? What if she lived to 80? What if she lived to 90, 95, whatever? And all annuities that have guaranteed income, the thought process is loosely the same. It's not the payout rate you want to focus on if you're trying to compare it to like traditional investments. You have to actually calculate the quote-unquote return, which using something like Excel and the internal rate of return function can do it. These things are priced and built such that if you live to average life expectancy, you get approximately 5% return. Now that varies as a market level of interest rate varies and the general account returns vary of the insurer. But for all intents and purposes, let's say if you buy a plain vanilla SPIA and you die at 85-ish, you're going to get approximately 5% return all said and done.
Over 20 years?
Again,
is this like a 65-year-old buying this? Or?
In this case, yeah. I mean, let's assume you're 65, you buy it at 65, you die at 85. You'll get approximately 5% return. Now, return's different than payout, like you said. You put $100,000 in, you get $7,200 out per year. That's a 7.2% payout rate. But again, some of those payments are just them giving you your money back. So the return is just like the interest component of it. And so the the internal rate of return calculation will calculate the return. And so the longer you live, the more payments you get. Therefore, the higher return you ultimately realize from that $100,000 you put in initially. Or if you die early and get less payments out, the lower return you get on that $100,000. So, if you do want to try to actually compare just pure return to pure return of annuities versus traditional investable securities, you have to do like an internal rate of return calculation. And you'll see if you live to average-ish life expectancy, you'll get approximately 5% return on the annuity. If you live to 110, congrats, you beat the house. You're getting 8, 9, 10% return.
Sure.
Who knows? If you die at 75, you get really skunked, especially if you don't have some sort of cash refund or death benefit value. So that people have to keep that in mind. And some people might be okay with getting skunked. Might be a bad word, but like, for example, you're single, you have no kids, you really don't care what's left when you die. Maybe you're fine with the fact that if you buy a plain vanilla annuity and die 2 months in, there's nothing left for anyone. Like, so what? That might not bother you. But if it does, you very much have to consider that then.
Yeah. Yeah. When we talk about payout, like you could go buy a 10-year U.S. Treasury bond right now paying you 4.2% roughly, right? But you still have the $100,000 always, assuming, and after
Correct.
10 years,
Correct.
the rate could be different. But this is something
Yep.
where it's fixed for life. Like, in this example, $600 a month as long as you live, and it'll keep coming in. Yeah.
Exactly. So they make sense, annuities. By they, I mean annuities. Make sense, especially when you want or need guaranteed income. It is a potential good solution. Where it gets complicated is, again, picking the particular type or chassis of annuity, because there's different ones to choose from. There's variable, there's fixed index, there's regular, just fixed. That's where consumers get lost, and I completely understand why. It's hard to boil down and sift through, here's what I want, what best does that. Like, that's ultimately what you should focus on when trying to consider an annuity, and be agnostic to the actual type of annuity, as long as it best meets what you're looking for out of it at the lowest cost. And assuming it's a decent insurer. Don't select some fly-by-night insurer who's just trying to undercut everyone else, because they might not be in business in 5 years, and there you go. You lost your guaranteed income if they go under.
Yeah.
Potentially.
No, definitely. I've looked at these for some clients, and it can get really confusing because there's a lot of them.
Yeah.
There's a lot of different features, right? How they work. So yeah, you need a good financial advisor, probably a fee-only financial advisor, because they're not vested in selling you one versus the other, because there could be different commission rates. Maybe the one that's not right for you pays a higher commission. And just also being able to look at all the options, whether that be one sold by a broker, or it could be one with like you were talking about, Advice One. There's other companies like DPL where it's, you're not getting a commission per se. So you're just getting whatever's best for you. Yeah.
Yeah.
And Charles Schwab has a tool, I think, also that I used years ago, that if you're looking just for single premium annuities, they have a tool where you can get quotes as well without having to give any of your information. Yeah.
Oh, really? For like direct end user clients, or through the advisor?
I think it's for
portal or
direct
something?
end user clients. I found it years ago for one of the classes that I teach, and I remember getting some quotes a couple of years ago, and I just put in like the state the client lived in, their age, whether it was a single or joint annuity, and it spit out numbers as far as, a 10-year certain, a 20-year, and then one with a cash refund. It didn't say the companies, so I didn't take it to the next step. I don't know what the companies are, but if I can find that, I'll put a link in this video and this podcast to that, because that could be another tool. Because like you were saying, it's nice to just get a quote and then not have your phone ringing from like 3 people that want to sell you an annuity. Now they keep calling you, and you don't even know if you want one yet.
Yeah, I absolutely hate getting sold anything, and I have such like this visceral knee-jerk reaction to any sort of sales in the traditional sense, or people being salesy. So I really appreciate sites where they'll actually give you information without needing to get yourself, signed up for something where now you're about to get pitched who knows what, because they have your email or phone number.
That's right. Yeah. Well, awesome. I think this is a good place to stop. Is there anything else you want to add before we wrap up this episode?
Not really. Just a lot of education. Learn annuities are complicated, but that doesn't necessarily mean they're bad. I think most products, whether it's insurance products or anything else, the product itself isn't inherently bad. It's how it's used or misused, I should say. How it's sold or missold is what could make the outcome of it not ideal for someone. But products themselves generally aren't bad inherently.
Yeah. I would agree. Yeah, that's a good thing to remember when you're dealing with annuities. Yeah, and investments
Definitely.
in general too. Yeah.
Yeah, like even mutual funds. There's some I mean, I think I can make more of a case there. I've seen some funds where it's like, I don't know how they exist. The fees are super high. The returns are just dogs compared to competitors, yet they still exist. So maybe there you can argue, yeah, there are bad products, but it's a separate topic, I guess.
For another podcast.
Yeah. There we go. We just created something new here. Yeah.
Well, thanks, Andy. Thanks for coming on. And, I hope you have a good holiday. And
you too.
For anybody that has, as I always, have as a listener question they want to have considered for a future episode, you can head over to retirewithryan.com and click on Ask a Question. And I hope everybody has a great holiday, and take care.
Thank you all.
All right.